Hey, do you want to know how to achieve a lower, more comfortable monthly payment with today's current mortgage rates? Well, an adjustable rate mortgage can be the solution. Understanding how these programs work is key to avoiding any surprises down the road. See, many homebuyers are drawn to adjustable rate mortgages because they offer low initial monthly payments, making homeownership more affordable in the short term. But what happens when the rates adjust? Well, I've seen buyers who benefited greatly from adjustable rate mortgages by planning wisely, while others faced unexpected payment increases that really stretched their budgets. So in this video, we're going to talk about how adjustable rate mortgages work, the potential benefits that they offer, and what you need to consider to ensure it aligns with your long-term financial goals. Knowing the ins and outs can save you from financial stress in the future, but more importantly, help you get into that dream home today.
Big topics that a lot of my clients are asking me about, right? Does it make sense to buy down the rate, right? So, in a low rate environment, buying down the rate is a great idea, right? Because, rates are already low, you're probably going to be in that mortgage for a longer period of time. Right now, we know that pretty much the majority of loan options that you're getting are short-term options, right? So paying an upfront fee to actually reduce your payment let's just say, if you're buying $1 million house, $800,000 loan, to get your rate down by 0.3% may cost you $10,000, right? The net tangible benefit is well over 3 years there. Right. And so it's, where am I actually saving, right? What's the, where should I actually be allocating that money to? And it's a philosophy that, it really depends on some people's risk aversion, right? And their risk tolerance. But that's why we're seeing ARM products, and depending on your price point, right, really taking off with some people, because, you could get an ARM while fixed rates are in the high sixes, you can get an ARM, in the low sixes, right? So
I want to just talk to you a little bit about, ARM's adjustable rate mortgages. I think, the last time that I remember them being relatively popular, they were perceived as a higher risk. It was a gamble because the rate you had today may not be the rate that you have tomorrow. Can you just talk a little bit about why ARMs are an option in my opinion, a strong option for consideration, especially now, and just a little bit about the different types, what the differences between a 1-1 versus a 5-5.
Yeah, no, absolutely. So ARMs, also known as variable rate mortgages, right, are they're tactical programs to use depending on, what your scenario is, right? So there's effectively, ARMs are amortized over 30 years, right? Which means that your payment is still extrapolated over 30 years, right? So some people think, I can't pay off the loan in 5, 7, or 10 years, right? That's not what the bank's asking you to do, right? So the most common products for ARMs are 3-1, 5-1, 7-1, and 10-1 ARM, right? And so what the first number indicates is the amount of years fixed for that particular loan, right? So in the instance of a 5-year ARM, the payment is still amortized over 30 years, but the fixed period is for 5 months, for 5 years or 60 months, right? And so what happens after, the 5 years is every ARM product is based on an index, a margin, and a cap, right? And so the first is the index that determines the underlying, rate for your product, right? So for instance, if it's the 1-year treasury, right, on year 5, month 61, right, you would literally look up what the index, what the rate is for the 1-year treasury, and then you would add what's called the margin. The margin, a common margin is 2.75%, right? So then you would take the index, add the margin, and that gets you what your rate is, right, on the first adjustment. And that's common for a lot of ARM products. The other thing that you have to start.
So when I see an ARM, those two numbers, that first number, let's take a 5-1. that first number is telling me that for 5 years, my initial interest rate will be the same, but then every 1 year after that, it's going to adjust, correct?
Yes, that is correct. The other product that we've started to see with the introduction of SOFR, it's a new indice that took over for LIBOR. I'm getting pretty technical here, but it's just a different index. Think of it like the Dow Jones, the S&P. It's a different index that's now been used. So common with the SOFR arms is a 7.6, right? Or a 5.6, right? Which means that it can actually change every 6 months as opposed to the year, right? And so, that's your loan officer needs to do a good job of explaining to you, what the risks are, what it looks like after year 5, right? And what the caps are, right? The cap is probably one of the most important aspects to understand when selecting an ARM, right? And there's 3 numbers. The first number that you see in the cap is the most that it could go up in the first year. The second number is the most that it can go up in the subsequent years. And the third number is the amount that it can go up over the life of the loan, right? So if you were to look at some of the standard ARMs, right, that aren't SOFR, right, you'll see 225, which means that in the first year, the rate can't go more than 2% higher than the note rate. And every year thereafter, it can't go up more than 2% every year thereafter. But over the life of the loan, it can't go up more than 5%, right? So that's one set. And then the other one is the ones that we've been seeing a lot more common now is 525, which means that in the first year, it can't go up more than 5%. Every year thereafter, it can't go up more than 2%. And over the life of the loan, it can't go up more than 5%, right?
So I want to ask you a question. I mean to jump in over you. So we're talking about the maximum that an ARM rate can go up. But if I'm not mistaken, if rates became more favorable, ARMs can also go down. True?
Yeah, absolutely, right? So that's also where it's important to know the fine print of the loan product, right? Because there is absolutely an opportunity to take, if the indice drops below where it currently is, right? Plus your margin is lower than your note rate, right? Your rate's actually going to be low. But there's some products out there where the rate actually cannot go lower than your note rate. So the lowest that your rate will ever be is but that's in the fine print, right? That's stuff that your loan officer needs to not rush into getting you into a shorter term option. They need to explain to you exactly what sort of product you're getting into. So, make sure that you have that discussion.
And then I guess my last question for you as we're talking about ARMs is that it also can be what I'm going to call a short-term fix. Because if I have a 7-1 ARM, so for my first 7 years, let's say that my rate is 6%. At any time in that first 7 years, I could also refinance if there was some dramatic change in rates, correct?
Great question, right? So a lot of people think, because, before Dodd-Frank, before 2008, you were actually allowed to have prepayment penalties on some loans, right? So, that's where sort of people got trapped in this. On all owner-occupied loans, right, you're not allowed to have a prepayment penalty. So at any point in time, right, you can refinance. So you don't have to wait for year 7. You don't have to wait for the first adjustment, right? You have to take advantage and keep in touch with your loan officer, right, to see, hey, listen, where are rates? Is now a good opportunity for me to refinance. One of the things that we do at Rate is we actually monitor rates for our clients, right? We have automatic triggers that tell us, hey, listen, reach out to John. He may have an opportunity to refinance. That is a great point. And, a lot of times that you take a look at it, right? I mean, right now, within 7 years, the majority of a lot of first-time home buyers won't actually be in that same home, right? So that's one thing to think about, right? The other thing is looking historically over the course of 7 years, in most instances, not talking about when rates were at 2 or 3%, there's been an opportunity to lower your rate, right? In a given 7-year period.
So just to summarize this, because I think there's been a lot of great information here. Inflation, jobs, all of these sort of economic indicators aren't a guarantee to really raise or lower mortgage rates, but they are indicators of the greater economy. Then when it comes to mortgages, I think that we are definitely seeing that with the appreciation in home prices, the controllable now really is the mortgage rate. So to buy now as a potential home buyer, you are in a better seat of control by locking in today's price as opposed to waiting to see that price go up another 10 or 20% over the course of a year or two, because the thing that you can control is the refinance on the mortgage. And then as we just spoke about, ARMs, variable rates, adjustable rate loans, provide an opportunity in some cases to get an initial rate that is better than a 30-year fixed. And depending on the term of that, whether it's the 3-year lock, at 5-year lock, 7-year lock, within that time frame, you could also refinance or potentially sell that home and move into a new property. And I just want to summarize that for anybody that's watching this video, because you've given a ton of great information, but I think that's the meat of it, that if I'm thinking about buying a home, what do I really need to think about and know? You were starting to talk about here refinancing, and I know that some banks are sort of forward thinking from a perspective of if a buyer takes a mortgage with them, regardless of the type, some lenders are assuming a refinance in the future and either providing some type of credit or certificate in that process. Is that something that you can talk a little bit about too, so that if I'm thinking about taking out a loan, but I'm concerned about what refinance looks like, can you just share a little bit with us about that?
Yeah. So, refinancing, because that's a great point, right? There is a cost associated with refinancing, right? But a lot of people think of it as, going through a whole closing like you did with the purchase, right? Needing to go to an attorney's office, right? It's a lot more simple than that, because there's now e-closings that we can do. But when you look at the overall cost associated with refinancing, right? Some banks have, waiving application fee, waiving appraisal fee. The main cost that you really have to look at, right, is title, right, in New Jersey, because that's one of the actual costs. That's, probably the majority. The government fees for refinancing are very small. It's less than $400, right? But the one thing that people sometimes get caught up on is, because it depends on your taxes, right, is needing to reestablish an escrow account, right, when you actually refinance. So when you purchased your home, you established an escrow, right? It's 3 months of taxes, let's just say 3 months of insurance, right? When you go to refinance, your new mortgage servicer is going to have to reestablish that escrow, right? So if your taxes are $1,000 a month, right, you're probably going to have just, between prepaids and escrows, a $3,500 fee, right? Because the bank needs to be able to reestablish that. But you're going to be refunded from your existing escrow. So it's money back in your pocket. And at the end of the day, it's being used to pay for your property tax, right? So I don't necessarily include that as a cost, but to actually get an estimate for a refinance on what it would cost is very, very simple. It takes all of 45 seconds. You put in what your new loan amount is, estimated interest rate, and the calculator spits it out in minutes. But it's very common for us to waive application fees and appraisal fees, to bring back existing clients, to maintain that relationship. Because I look at it, I work with my clients almost on a daily basis from the point that we get your loan submitted into underwriting until the day of closing. I like to think that I establish a good relationship with clients, through that time. And, we definitely want to do anything we can to ensure that we retain, them
Thanks for watching. We want to make sure that you're fully prepared for the 2025 real estate market. So message us directly. Request a free home loan toolkit packed with expert tips and must-ask questions. Plus, check out our other videos for more insights or schedule a complimentary consultation with any of our agents today. A strategy session is the best way to find out what your options are and talk about your unique situation. Don't leave your mortgage to chance. Take the right steps today, and we look forward to talking to you.